morning, ladies and gentlemen. It is my pleasure to welcome you to the Altron annual results presentation for FY21. My name is Nicholas Porfilatos and I look after investor relations for the Altron Group in conjunction with our Chief Financial Officer, Cedric Miller. I trust that you've been able to access the presentation, which is available on our website within our investor section, along with our financial results. Please be assured that as we are presenting to you today, we are adhering to all COVID-19 protocols, including social distancing. Our program this morning will run as follows. Mteto Nyati, our Group Chief Executive, will speak to the key priorities for FY21, along with its key highlights. He will be followed by Andrew Holden, our Group Chief Operating Officer, who will speak to the operational performance of the business. Cedric Miller, the Group Chief Financial Officer, will address the financial results, and thereafter, Mteto will conclude on our presentation with an outlook on the company. We shall have a Q&A session at the end of the presentation, so please type your questions in the chat box made available within the webcast. I would like to now invite Mteto to the floor. Thank you.
Thank you, Nicholas. Good morning, ladies and gentlemen. Welcome once again to the Altron annual results presentation for FY21. A special welcome to our chairman, Mr. Mike Leeming, members of our board, ExCo members, and the managing directors that are running our operations. FY21 was a tough year. Yes, it was very challenging. In fact, we faced twin evils of COVID-19 pandemic and also the negative economic climate that faced a number of our operations. As a leadership team, we came up with 3 priorities for the year. The first one was about managing through the pandemic, COVID-19 pandemic. The second one, because we had established that we could unlock value for our shareholders, it was really about how do we execute on that. The third priority, having done the demerger of Bytes UK, how is this Altron 2.0 going to look like? So those were the 3 priorities that we had for the year. Starting with the first priority, I must say that we are in a very good position within Altron to have an engaged and a very strong board. Together with that board, we were able to put together key focus areas for the year to address the pandemic. The first one was about protecting our business. Here, it was very important for us to make sure that we look after the well-being of our staff. At the same time, we had to make sure that we leverage all of the work that we have done over the years to digitally transform Altron, to use that to enable all of our employees to be able to work remotely. The second priority, of course, was about sustaining our business. Here, when we looked at level 5, it became clear to us during the level 5 lockdown that a few of our operations were experiencing really negative impact from COVID-19. So we had to act quickly. In doing that, we had to right-size our business. And unfortunately, in those operations, we had to let go about 650 of our colleagues. This was a very difficult decision for us, but it was a necessary decision to ensure sustainability of our company. The third priority that we have was about securing funding and also making sure that we have liquidity in our business. Here, led by our CFO, we had to secure additional lines of funding, just as a precaution. The good thing is that we never used those lines of funding at the end of the financial year. We also cut back significantly our capex to make sure that we had the liquidity that we thought we needed as a business. And the second priority of unlocking shareholder value. Here, I would like to take you back to 4.5 years ago when we shared with you the One Altron strategy. This is the strategy that has guided us over the last 4.5 years. You will remember one of the priorities that we had as part of this strategy was to deliver leading returns for our shareholders. The question is, how did you do across the period? Looking at the first 3 years, from FY13 to FY20, we were able to increase the market cap of our company by 118%. Getting into FY21, when we announced the unlocking of BICE UK, you will see there that we're able to increase the combined market cap of Altron together with BICE UK by 201%. The other way of looking at it from a per share basis, on a per share basis, we were able to do in the last financial year, we were able to increase the value by 147%. But if you were to also add the special dividend that we have just declared, that will be paid today, we'll see that we're able to increase it by 152%. Yes, it's one thing to be looking at internal measurement, but we also do need to look at how well have we done against the market. If you look at across against the market, here looking at starting from FY17 up to the end of FY21. Here we see that we have outperformed both the JSE All Share Index and the Mid Cap Index in South Africa. Here now I just want to take you through some of our highlights for the year, the financial highlights. I will start at a group level. At a group level, we delivered a revenue of 15.5 billion rands. This represents 7.5% decline year on year. Unfortunately, this number is not a like-for-like comparison because we had BICE UK only for 9.5 months, whereas in the previous year we had it for the full year. Hence, I am going to skip this slide and go to the slide which I feel represent how we have done operationally in FY21. Here, looking here purely at the continued operations, we delivered a revenue of 7.4 billion rand, which was largely a flat year-on-year growth. I must say, I am pleased with that performance, given the challenges of COVID-19 and the negative economic climate that we face in many of the territories where we are working. Our EBITDA was down 8.5%, delivering 1 billion rands of EBITDA. Headline earnings per share, 31 cents per share, down 18.5%. CapEx, you may remember when we were speaking about liquidity, one of the focus areas here was to cut back on CapEx. This is the year when we had already communicated that we'd be spending quite a lot around a new campus, 128 million that we've spent on the new campus in the last financial year. Even with that, year on year, our CapEx spend was only up 22 million rands. This reflects the cutting back of CapEx throughout the rest of the group. Our operating free cash flow was up 600%. I must say that I am particularly proud of the work that we have continued to be doing around working capital management. We started to focus very seriously around this two years ago is starting to become part and parcel of the DNA of our organization. We can see that we're able to release about 230 million rands from working capital. The return on invested capital, we see that it was 5.8%. Clearly, this is not something that we are particularly proud of. And you will hear me coming back to this point, and I'm talking around the outlook, where I will be sharing with you our roadmap to how we can be significantly better than the weighted average cost of capital of the group. I am happy to communicate here today that our board declared a final dividend of 15 cents per share. My final slide in this area, we always communicate to you the priorities of the half that we are going to be going after. We, during the interim results, communicated these priorities. The first one was the Bytes UK, cost savings, City of Tshwane collection, the Power Tech collection, reducing our debt, and of course, communicating our strategy to the rest of the market, the Altron 2.0 strategy. Against that, how did we execute as a team? Of course, we all know how well we executed on the Bytes UK demerger. Cost savings, we as a team have put ourselves as an amber there. It's an amber not because we did not drive cost savings within the group. We did, and we did that very well. But in our mind, cost saving, we can never get there. It's an ongoing effort of continuous improvement. So we'll always be keeping cost saving as an amber. The City of Tshwane collection, as much as we were happy with the judgment that we got, the city decided to challenge that judgment, and the decision now is sitting with the Constitutional Court. We expect that decision hopefully within the next month or so. We were able to collect the 50 million on the Power Tech transformers. You will hear from Cedric how well we have been able to reduce our debt, and many of you probably were part and parcel of our Capital Markets Day, where we communicated together with our managing directors the strategy, Altron 2.0 strategy. It is now here that I would like to invite our Chief Operating Officer, Andrew Holden, to come and share with us the performance of the various operations. Andrew.
Thanks very much, Mteto. And you'd be pleased to know I've only got 2 slides, but I'll be talking a lot about those 2 slides. So let's have a look at the sort of the operations in 2 halves, those that are negatively impacted by the pandemic and the subsequent economic slowdown in South Africa, and those that are positively impacted. So let's start with the negatively impacted, and we look at the medium-term impacts of the environment, and this includes Altron Document Solutions and Altron People Solutions. And if everyone recalls, at half year, these 2 companies were very, very stressed. We made it our aim in the second half to improve into a break-even or a positive for the second half. I'm pleased to say that Altron Document Solutions, we managed a positive second half in the year. That was on the back of the cost savings that we initiated in about July, August last year, and part of those 650 people that were taken out of the operations that Mteto alluded to was in the Altron Document Solutions space, where we dropped our headcount by about 22%, and it ended in the positive territory for the year. People Solutions, we weren't so fortunate, and although we took out around about 300 people, we continued to struggle in the second half of the year. I'm pleased to tell the audience that in the beginning of this year, all the efforts that we've done from a sustainability point of view are certainly paying off this year into Altron Document Solutions and Altron People Solutions. But it's going to take longer to recover. And if everyone recalls, a year ago we were talking about Altron Document Solutions with about a 3% year-on-year negative growth in the printing environment, and obviously this COVID has accelerated that, and we think that the bar has been reset around about 32% lower. And as we move into the following year and as restrictions start to lift, I think that'll recover slightly, but it'll never go back to the previous highs. And then we look at the short-term impacts, Altron systems integration and Altron Arrow. Now, Altron Arrow, if I start backwards, also negative half year, but in the full year, it's turned out to be positive, around about 15% up year on year, and I need to congratulate that management team into doing a sterling job, despite the revenue having returned to profits a year-on-year growth, as I said. Altron systems integration, we expect to recover this year based on the fact that if we look at what we did is contain our capital expenditure, focus on liquidity in the business, so too our customers are really much focused on those two environments, which impacted the short-term projects that were delivered out of Altron systems integration, and we expect a recovery, and I'll talk about that recovery on the next slide as well. The recovered environment, so fintech and health tech, during the hard lockdowns of level 5 and level 4, many of those doctors weren't operating. Many of the fintech environments, in particular unsecured lending space, their shop fronts were closed. As we went into level 3 and then subsequently into level 2, that opened up, and I'm pleased to say even right now they're back to their pre-COVID levels of transactions, and we forecast a pretty good year for them into the FY22 space. In the resilience space, or the people that are positively impacted, or the businesses positively impacted by the events of last year, we look at Netstar, and despite the fact that new car sales were tremendously impacted, and particularly in the first 6 months of our financial year, our high annuity base saved that business from any decline at all, and we've had a pretty good year on year. Our churn still remains a little bit of a problematic environment, but I'm pleased to say that we made some headway around churn. I'm talking about the negative churn. It was not obviously offset by the positive growth, so we still have a job of work to do going into FY22. Altron Nexus, if everyone recalls, in the prior year we had a negative for Altron Nexus, brought in new management towards the end of FY20, and this new management has stabilized the ship, and we've moved that back into positive territory with the closeout of Limpopo project in February this year, and looking forward to a renewed efforts into the GBN phase 2, as well as Eskom wins that we've had. Looking at Altron Managed Solutions, very much an annuity-based environment, and a great year last year, really maximizing on the wins that we've had in the prior years and stabilizing that ship. So a good job from that management team as well. And then the two that are very positively impacted by the COVID situation is we brought in Abusha, we rebranded Altron Security towards the mid-year, and that business is really about securing your customers into the cloud environment, securing the identity, and they've had a great year, and an accelerated year almost. Altron Caribbean is the second one that has benefited from Microsoft's big drive into the cloud, and towards September 2019, we got awarded an LSP contract from Microsoft, and that started showing profits in towards the half year, and a good year on year. Some challenges into some of the project deliveries, particularly into the end of the fiscal year, and that's been set up properly, and we're looking forward to a good FY22 from Caribbean as well. We look onto the second slide, and now this is slightly reorganized, and I want to talk about the discontinued operations. And this operation, you can see at the top, we've only down by 23 million rand year on year, but here we have 4 businesses in the discontinued operations. And let's just start with the Bytes UK operation. And the Bytes UK, as everyone has seen in all the announcements that we've made leading up to the demerger, Bytes UK has done exceptionally well. So that 706 that we see in the EBITDA numbers is flattered by the UK. The other 3 operations held for sale, Document Solutions, People Solutions, and Arrow, combination of those 3 businesses lost us 130 odd million rand year on year. So these are the areas that we are focusing from this year. We are running a process where we are looking to sell off those 3 environments, and that will close coming Friday, and hopefully we will have decent offers on the table, and we can transact those offers in the next month or so. Moving on to digital transformation. In the digital transformation environment, we have three businesses, and those are namely systems integration, Carabiner, and the new Altron security environment. So here, looking at 40 million rand down year on year, and this is driven by two things really. Systems integration, as I say, slow down on the revenue side, but in this year we found ourselves taking a little bit more of a conservative approach to some of our debts, and we raised quite a bit of doubtful debt into that environment. And again, we trimmed down in the latter half of H1 last year the headcount, and we took around about a 10 million rand once-off cost in that environment. Africa is included in this space, and Africa also had, and we're talking about mostly Kenya and Mozambique, is a year-on-year loss, around about 29 million rand delta. And we've then looked at Aroa, and we've changed our model, and we've moved the focus back into the operations, and we'll more focus on organic growth into that space. And then I mentioned Abusha that we bought and renamed Carabiner, so that's in these numbers, the 113 million, and that lived up to our business case when we acquired Abusha and brought it into the operations as of the 1st of March last year. Carabiner I touched on, and although they slightly improved on an EBITDA point of view, 2 million rand in the prior year to 5 million rand this year, it is obviously not where we wanted to be, and a lot of focus going forward. Look at the own platform business, and this is made up of three entities in the own platform. This is Netstar that we covered already, and FinTech and HealthTech, and you can see the resilience in that business, only 5% down, whereas the economy roughly is around about 10% down. And then the last of our segmentation, managed services, and I touched on the managed solutions environment, and Nexus is in these final two, and you can see a slight improvement of 53 million, and maybe not so slight with the 42 million rand, but again, slightly flattered with the turnover or the turnaround in the Nexus environment from a negative in the prior year to a positive in this year. So hopefully that gives us a sort of the sum of the parts with this environment. And then the 2.0 that Mteto will come back and talk about would be obviously digital transformation, our own platform businesses, and the managed services environment. So with that, I want to hand over to Cedric, our Group CFO. Thank you.
Thank you very much, Andrew. Now, Andrew touched on the operations that were both positively and negatively impacted by COVID. But on the whole, it is pleasing to see that the Altron 2.0 portfolio showed significant resilience, not to only maintain pre-COVID revenue generation levels, but actually growing it slightly on a like-for-like basis. Just to remind everyone that the correct way to look at our revenue is in fact gross invoiced income, as this is what drives our margins and working capital. Furthermore, we are very pleased with the strong performance of our recent acquisitions in the security space. Taking into account that this transaction closed on the 1st of March last year, a mere 4 days before the first COVID case was reported in South Africa. And yet this acquisition performed according to its investment case throughout the COVID period. Combined with this recent acquisition, gross invoiced income grew a respectable 4%. Before we work through the detail of the continued operations summarized income statement, we need to reflect on what has changed since our interim reporting. Now, the major change is that at interim, the Bytes UK results still form part of our continuing operations. But since Bytes UK has been demerged, the results of its operations up to demerger date are classified as discontinued operations, and therefore do not form part of these numbers. Consequently, the comparatives have also been restated to remove Bytes UK. The results on this income statement therefore reflect results on a like-for-like basis. So let's step through the line. So although statutory revenue remains flat year on year, we have given you some color on gross invoice income on the previous slide. EBITDA is down year-on-year by 8%, which indicates margin pressure when referenced against the 4% gross invoice income growth, and I will unpack this in more detail shortly. Funding costs benefited from lower debt levels combined with a lower interest rate environment. And as has been mentioned, a final dividend of 15 cents per share has been declared by the board, bringing the total ordinary dividends for the year to 48 cents. But in addition, we also had the special dividend declaration of 96 cents, which is payable today, and then clearly there was also the big dividend in specie relating to the Bytes UK demerger. To better understand our margins, statutory margins need to be adjusted for the anomalies of IFRS 15, which only recognizes agency margin as revenue and not actual invoiced income. So as can be seen on this slide, our real operational margin decreased by 170 bips, and this is expressed as a percentage on gross invoiced income. So the key takeaway from this slide is that the margin compression does not stem from our operating segments. In fact, the margin on our operating segments held up very well during the year. Rather, the margin decrease stems from our central costs, which include a number of once-offs. Example of these once-offs include the penalty cost, for example, that we incurred to early terminate one of our leases in order to reduce long-term leasing costs. Another related to restoration costs when we exited our Altron Midrand campus. We also suffered some forex losses when the ZAR depreciated sharply in the early weeks of the pandemic. And where we had to right-size our cost bases, we incurred severance costs. The point being is we don't expect these once-off costs to repeat going forward. And furthermore, Mteto will elaborate in his outlook section on material head office cost reductions in the foreseeable future. Moving on to working capital, at the end of last year, we reported working capital of just under 1 billion rand. However, as Bytes UK has a negative working capital cycle, the remaining group's working capital was closer to the 2 billion mark, as can be seen on the left-hand side of this slide. So on a like-for-like basis, we have reduced working capital by almost 280 million rand during the year. All of our business units contributed to this reduction, save for digital transformation, which has increased slightly due to the acquisition of Abusha in our security business. Some aspects to note is that in our 1.7 billion rand closing working capital number, there is almost 700 million rand relating to operations held for sale, and a further 300 million relating to the City of Tshwane funds outstanding. So if we look back, excluding Bytes UK at the beginning of the year, we had working capital of around 2 billion rand. We have every expectation to reduce this by at least 2/3 to around 700 million rand post completing the disposals and collecting money due in relation to the COT transaction. Looking at our cash flow, we can see that our cash generated from operations was just over 1.8 billion rand. This would have included cash generated by Bytes UK while they were still part of the group up to the date of demerger. And as discussed in the prior slide, there has been a release in working capital from the group, which was further assisted by a release of working capital within Bytes UK prior to their demerger. The majority of the proceeds on disposal relates to net cash received in relation to the participation in the Bytes UK demerger through our treasury shareholding. And included in investment activities is the Abusha acquisition of some 250 million rand, investment in PPE of about 300 million rand, which includes our new campus and warehouse, and 140 million rands worth of capital rental devices within Netstar. The remainder relates to the demerger cost associated with the Bytes UK transaction. So what did we do with this cash? So we reduced debt by the dividends and proceeds received from the Bytes UK and its demerger. And then finance activities are driven by the acquisitions of minority interest in the Netstar and Nexus space of about 80 million, with the remainder relating to lease payments. Moving on to my last slide, we have seen a significant reduction in net debt during the financial year, largely attributable to funds received in respect of the Bytes UK demerger via our treasury shares, but also from the positive contribution of a reduction in working capital. The zero debt to EBITDA ratio is below our long-term guidance of 1, and it is certainly not our intention to fund our business entirely from equity, and we expect the medium-term ratios to return to a ratio approaching 1. We have also some further potential upside from a debt perspective, relating to the COT funds, the proceeds on our held for sale assets, and outstanding proceeds from disposals in prior years. But this will be subject to our capital allocation methodology, which Mteto will touch on shortly. And with that, I hand you back to Mteto, who will take you through the outlook section in our presentation. Mteto.
Thank you, Cedric. In this last section, what we wanted to do is to walk you through some of the characteristics of Altron 2.0, the strategy itself, and the opportunities that we see in the various segments within this. But at the same time, as I had promised, I want to also walk you through some of the actions that we are planning to take with regards to the improvement of the return on invested capital. Before I do that, though, I know that Andrew has already touched on the status of our held for sale business. I want to highlight here is that the key decision point is going to be at the end of the month when we'll receive the binding offers for these operations. So we're looking forward to that point. Getting into Altron 2.0, I want to just here go back a little bit into the strategy itself and just highlight that here in Altron 2.0, unlike in one Altron strategy, we have here 3 segments. It's the managed services, it's the digital transformation segment, and its own platform segments. And we're expecting growth across all of those segments, driven by the growth areas that we have identified as a business, being cloud services, security, data, and automation. Looking at our own platforms business, this is a business where we believe we've got a great opportunity. The opportunity here in this space lies in scaling the business. We already have these platforms. The key is to put a lot through the platforms that we already have. And if you look at the characteristics of this space, it is largely driven by the fact that it's our own IP. Linked to the fact that it is our own IP, we can see that the margins are high. The lowest margin within the space, we're talking about 52% gross margin. The annuity income, the annuity revenue in this space is very high too. We're talking about the fintech being the lowest, sitting at about 77%. In terms of the return on invested capital, again, we're seeing a great opportunity for this business. It's going to be even more so as we put a lot through this business, as we scale these 3 businesses. There's going to be a strong focus around Netstar and getting that ROIC for Nesta going above 20%. The digital transformation, if you were to be thinking about our company and in terms of the revenue growth, this is the segment that is going to be driving that top line and of course bottom line growth. Because here it's aligned with what is happening in the market. We have aligned these businesses with digital transformation, with data, with security, with cloud services. All of these, if you look at it, the compounded annual growth rates across these various segments, all of them above is double digit. We're expecting to be growing in line with that. This is the segment that is going to be fueling our growth. And within this segment, we're talking about 3 operations. It's Altron Carabiner, it's Altron Systems Integration, and it's also Altron Security. Looking at the systems integration business, here we have shared with you, just unpacked what is it that this team is focusing on. What are the businesses that we have under systems integration? We have security within systems integration. We have data and artificial intelligence capability within systems integration. We also have managed services business within systems integration, cloud, and when we're talking cloud, we're talking across the various clouds here. They are not married to any one cloud. We're talking AWS, we're talking Amazon, we're talking Microsoft, we're talking Oracle. It does not matter. Our focus is to support our customers, whichever cloud that they've chosen to go to. And also, last but not least, the DevOps or automation or modernization. All of these segments are high growth segments, as you have seen. The other area that we are so excited about is the security opportunity within the market. And a year ago, we made the decision to acquire Ubusha, which we have rebranded now to Altron Security. And we were very impressed by how this business performed throughout the pandemic. In fact, we were able to deliver in line or slightly better than the business case that we have put together to acquire this business in a COVID-19 environment. Look at how we have done that. There is still so much that this business can do, because right now, our concentration is on very large enterprises. Almost all of the banks are their customers. Almost all of the telcos are their customers, the same as insurance companies. But we have so many other customers that we can take their capabilities and their offerings to, in the top end of the market, all the way down to mid-market. So there's a lot of room for us to drive growth with existing capability within this business. But at the same time, we're seeing their capabilities and their offerings being in demand in other markets, in particular in the UK. It is for this reason that we have established an operation there in the UK to go and capture that opportunity. The good thing is we will be able to deliver some of that from South Africa remotely, which is great. And of course, when we look at the needs of our customers, we know for sure that Ubusha does not satisfy all of those needs. It is for this reason that we have identified an opportunity to acquire another company that can help us to provide end-to-end capabilities around security. And that company is LawTrust. And what is it that they are bringing to the party? LawTrust is bringing digital trust services. What does that mean? What it means really is that we are bringing identity proofing. We are bringing signaturing solutions to our customers. And also we are bringing in the accredited trust center. Things that are so key for the digital space that we are living in. So the capabilities of those two organizations will make us to be even more relevant to our customers in this space. What we like a lot as well is that in what we have in Law Trust is the high annuity revenue together with the significant amount of our own IP. Carabiner. Carabiner, we have been set back probably two years, and we were very happy to see the level at which they were able to close new signings during COVID-19. The level of the amount of backlog, the signings backlog that we entered in this new financial year with, it was really, we're happy to see that. We can start to see that Carabiner is starting to live to its promise. When we look at the last 3 months, we can see how we have been really helped by COVID-19 and how across the key financial matrices that this business is starting to grow and grow significantly. And it's going to be critical that we sustain this. The good thing is we already can see a great pipeline of backlog that we just have to deliver on it to implement those solutions to our customers. But the other problem with regards to this business was not just about the new signings, new business signings. It was how well were we managing the projects that we have already closed. And we have managed to put some key disciplines in place here to minimize or eliminate the losses. In fact, last year at this time, we had 4 projects that were making losses. And we have been able to renegotiate those projects with our customers. And now 3 of those projects are delivering profits, which is really how it should be. So we are excited about this business going forward at the back of digital transformation. At the same time, when you look at the growth that is driven by the whole Microsoft ecosystem in the market. Head office is an area where we felt as a team we needed to make a big change. With the demerger of Bytes UK, we had to look at, do we really have to have a head office of this size? And with that, we have made some big changes and restructuring that we have done. Painful, but something that was necessary. And we are taking the head office cost from about 235 million last year to this year around 150 million. Our plan is that by FY24, we should be below 100 million rands of head office. Having done and looked at the operations that we have, yes, we'll be executing on the disposals and have that cash coming through there, and also we'll be having Altron 2.0, which is very much cash generative. What is it that we are going to do in terms of the cash? What is our thinking around capital allocation? As a team, we feel that our primary responsibility as management is to continue to look for growth opportunities. And here, those opportunities lie through acquisitions. And we have been very clear about the kind of acquisitions that we are going to be going after. We have seen what we've done with Ubusha. We have seen the acquisition that we've just made in terms of Law Trust. It has to have certain characteristics. Certainly, in our growth areas, very, very important. It has to be capital light. It has to be high annuity. And our preference is that it must have its own IP. If we cannot get that, of course, the next best thing to do is to reduce our levels of debt. But even when you look at where we are right now, our debt levels are low. So what is it that we are planning to do? Cedric has been very clear that we have a dividend policy with a dividend cover of 2.5 times headline earnings. In terms of our continued operations, we'll continue to do that. But if need be, we have no doubt that our board will look at a special dividend or, of course, a buyback of shares. So this is really how we think about the allocation of capital within our business. First and foremost is the growth, driving growth at the back of digital transformation, managing and reducing our debt levels, and of course, giving back some money to our shareholders. I had promised to come back to the return on invested capital and see how are we going to be improving that. Starting where we are right now at 5.8%. Here, the exit of low ROIC operations is critical. We are already executing around that. We've got about 309 million rands tied up in the city of Tshwane. That is a very important collection that we have to make. I have already highlighted what is it that we were planning to do with our own platforms. These are businesses where we already have the IP, we've got the platforms in place. The key is to scale those businesses. That is going to be absolutely critical in driving up this ROIC. And I've just highlighted now our roadmap to reducing the head office cost to below 100 million in FY24. With that, we believe that in FY24, we will be significantly better than the work of the group. So to conclude, what are our priorities for FY22? Yes, one, the disposal of non-core assets, very, very important. That we are almost there, currently waiting for the binding offers by the end of this month. Absolutely critical that we execute on that. The expansion of the businesses that is in Netstar and elsewhere in the security business, absolutely critical. The value unlock, this is something that we cannot not continue to do. If there are opportunities for us to do further unlock of value within our operations, we are not going to hesitate to do that. It may mean unbundling, it may mean selling of an operation. We will do that, but at the end of the day, it must be something to do with, as long as it's going to be a significant benefit to our shareholders, we will only execute based on that. And last but not least, we have to continue to maintain our track record of execution. Here, what I would like us to see doing is to make sure that accelerate the growth within systems integration business. We sustain Altron Carabina turnaround, and of course, make sure that we continue to improve some of the aspects that are not so good within the Netstar operation. So with that, I would like us to now move to the Q&A. That concludes our presentation. We will now move to Q&A. Thank you so much.
It is now time for our questions and answers session. I would like to remind you again to post your questions in the webcast. A number of questions have begun to stream in, so let us begin with the first question. What are the top 3 to 5 operational or financial metrics that management is obsessed about across the Altron Group, and are these consistent with the 3 reporting segments?
Thank you, Nicholas. I will take that question. I want to just focus on the 4 that are key for us, the matrices that are key for us. The first one is the top line growth. Revenue growth is key. We want to be in spaces where we can grow and continue to grow. As you can see, our strong focus on growth areas of data, cloud computing, security, and automation is linked to this key metric. We want to grow. Second is the operating income. That is another key metric that we have as a business. The third one, starting maybe about 2.5 years ago, where we've had this strong focus on working capital. It will continue to be our key focus going forward. And the last but not least metric is ROIC. This has now become the standard within our operation. Each and every operation, we're looking at it in terms of ROIC and also looking at the ROIC for the group. So the key, the 4 ones is revenue growth, is operating income, is working capital, and also ROIC.
Thank you, Mteto. For our second question, Altron 2.0 target to triple operating income by 2025. To achieve this, I understand that Altron are targeting low double-digit revenue growth per annum. Please, can you advise on the target EBITDA growth over the 5-year period and the baseline EBITDA?
I'll ask our Chief Financial Officer, Cedric Miller, to handle that question.
Thank you, Mteto. I think before we look at our 5-year targets, it is important that we just understand that as a group, we've always used, as the industry standard, EBITDA as a profitability metric, because EBITDA largely approximates our ability to generate cash. However, with the introduction of IFRS 16, basically all of our lease cost has been removed from EBITDA. So EBITDA is no longer in our scenario a proxy for cash generation, and hence the focus to operating income, which more approximate cash generation. So correct, with a baseline of around 450 million operating income, as we reported in Feb 2020, we want to triple that over a 3-year period, a 5-year period. The EBITDA will probably be slightly less, and it will be between 2.5 to 3 times from an EBITDA perspective, but with a clear understanding that we will start to focus on operating income as a metric as opposed to EBITDA.
Thank you, Cedric. I see our third questions come in. Digital transformation businesses have materially lower annuity revenue percentages to total revenue than the other 2 segments. Why is this the case, and what are you doing to change the status quo?
Nicholas, thanks very much. I'll take that question. And if we have a look at the digital transformation area, just to repeat, let's talk about the biggest one, Altron systems integration, roughly 2.2 billion rands worth of revenue, very much focused in 2 segments of and I'm talking about the revenue segments here. The DevOps environment is a large environment, typically driven by 2 things, is project revenue and driven by then the annuity revenue post that. We do have a large business in infrastructure, and as we change into the cloud, you'll see that annuity growing, because cloud revenue or XAS revenue as a service revenue is annuity based. So instead of selling, let's say, a network or selling a data center, you're moving that into the cloud, you're moving that into software-defined networking. So annuity will certainly grow. In the carabiner space, it has been predominantly on the back of projects over the years. Now, there's 2 changes running in that environment. Firstly, the LSP space. In the past, selling an EA would have been defined as a project revenue or a once-off revenue. But as you move into that sort of cloud revenue and CSP, so the cloud service provider, it turns into annuity. And the second driver is obviously those projects around D365, both in the F&O space and the CE space. That will continue to play a role, but we are building, let's say, a support initiative around the D365 that we will then convert into the annuity drivers. The security space, now we have two security spaces, both in SI as well as the Altron Security, which Law Trust will be merged into if it successfully goes to the ComCom environment. That will be largely project-based still within the old Abusha or Altron Security, as Mteto alluded to, as we put Law Trust into that very, very high annuity base, and that will drive that annuity space. Then in the cyber tech environment, which we reported on last year, we've merged that in with SI, and that's more to do with the perimeter security and the monitoring, and that's a high level of annuity space. So hopefully give you a color on what there was there and what we're driving towards. So thanks very much for that question, Nicholas.
Thank you, Andrew. We can move on to the next question. Are Altron companies like HealthTech, FinTech, Netstar, Abusha collaborating with Bytes UK in order to drive offshore revenues?
So thanks, Nicholas. I'll take that question as well. So if you have a look at, I'm going to deal with them as separate environments. So HealthTech, if we recall from the past, we've reported on HealthTech very much involved in the private medical or health care segment in South Africa, and it is not the same in the UK. UK is dominated by their national health. So 1.2 million people work for the national health. So there is very little scope to take our current HealthTech business into the UK. In the future, when we move it more into the public space and focus on public records, health records, and so on, there would be space to move it into the UK. The fintech business, very much our fintech business here, focused on unsecured lending. It's a big space in the developing world, not so much in the UK. Netstar, on the back of the Toyota deal, is growing internationally. But we don't need the collaboration of our Bytes UK environment because your buyers are different. It's a consumer-led market on the stolen vehicle recovery, on the vehicle telematics, and very focused on sort of the logistics environment. But on the Altron security side, we have launched a greenfields environment within the UK, and that will focus on identity access management, and there are already existing links within the Bytes UK space, both out of the old Phoenix operation running out of New York, focused on the government space, and really the enterprise business focus from the Leatherhead space. So we expect that to drive growth, and we will then deliver this value from offshore, and we just need to be careful and to abide by all the papaya and the GDPR rules that we can't offshore data, but rather monitor and react from South Africa with our data being stored in the UK. So hopefully that also sort of gives an element of where we're headed, and we're not aiming at competing with our business in the UK, but rather complementing the existing services.
Thanks, Andrew. In reference to Mteto's ROIC discussion, the next question is asking, what are Altron's targeted ROIC numbers?
I'll take that question. Thank you. Thank you very much, Nicholas. So clearly our first port of call from a ROIC perspective would be to at least meet cost of capital for the Altron Group that's currently just north of 12%, right? But then as we step through, we don't just want to meet the weighted average cost of capital. Clearly, in the medium term, we want to be materially above the weighted average cost of capital. And I would put materially 30, 40, 50% above the weighted average cost of capital. And then clearly with a long-term target to get into the late teens, if not early 20s.
Thank you, Cedric. Our next question asks, there has been a lot said about integrating the previously siloed Altron businesses. Would further sales or unbundling therefore be possible if businesses are now more integrated?
I will take that one. Yes, we drove the One Altron strategy, but that One Altron strategy was really not about integrating the different operations and making them into one. We have actually kept the identities of the various operations. As we have moved into the new campus, you will see even there that each one of the different operations are still occupying different buildings, because we believe that they need to continue to drive a strong focus with their area of focus. So that is what we have done. What we have done, though, and the sales side of things, is to help our salespeople to be able to identify opportunities that may belong in other operations. And also, when it comes to the delivering of services, we are able to leverage the capabilities that reside in other operations. So there is more collaboration, but we have not lost the identities of the different operations. To answer your question directly, if we were to get to a point where we believe one or two of our operations need to be unbundled, it would be done very easily because they have not been tightly integrated.
Thanks, Mteto. A follow-up question on our key financial metrics to measure is, if EBIT is a more appropriate measure, why is this not your reporting number for the underlying businesses?
I'll take that. I think that's a very fair question. Clearly, the market is very au fait with our EBITDA numbers. A lot of the models has been built. So we will work with the analyst community, actually publish both sets of numbers as we transition to operating income or EBIT as a performance metric going forward.
Thanks, Cedric. The next question that's come through the stream is, how comfortable are you of exceeding the pre-COVID EBITDA of 1.1 billion in the year ahead?
So thanks, Mteto. I'll take that question as well. If we have a look at exceeding the number of the EBITDA in the year ahead, and we look at the challenges that we faced in some of the operations, and notably the Carabiner operation, the systems integration, and some of the once-off costs that we incurred in the head office space and so on, we were very comfortable with the trajectory that we've put in place for this year and growing the EBITDA. And I'm talking around obviously the 2.0 environment post the disposal process of the 3 held for sale operations.
Thanks, Andrew. In relation to our current debt position, how should we think of finance costs in the year ahead, given that you've settled the majority of your debt?
Thanks, Nicholas. I'll take that question. So, yes, we have reported a sharp decrease in our debt numbers. However, I think we also need just to understand a little bit of context. So the first one is the special dividend that we are paying today. So again, that would increase our debt number from the 400 million reported debt number. We also, hopefully will conclude the Law Trust acquisition. There is a further 240 million. And then we also have the last bit of cash that needs to flow relating to our campus. And that's why I mentioned that our zero debt to EBITDA is not a sustainable number going forward. But nevertheless, you are correct in that our debt levels will be structurally lower than what it has been in the past. And I would, basically discount our funding cost by at least 40% from what it was reported in FY21.
Thanks, Cedric. Moving to the next question in the stream. What does the equity accounted loss of 41 million and 30 million in the previous year relate to? I had not noted equity accounted losses before, and how did this arise?
I'll take that one as well. So in short, we had a operation, CBI, in the past that we have classified as held for sale, but because of the elapse of time and we have not managed to dispose of this business, even though it is still our firm intention to dispose of this business, we had to reclassify it back into continuing operations, and consequently we had to restate both the prior year number as well as this year's number. So in essence, the equity accounting loss that you see there relates to CBI, and which has been brought back from discontinued operations into continuing operations and has been written down to zero.
Thanks, Cedric. Our next question talks to the operational performance of Africa. Is the rest of Africa business growing at a faster pace than South Africa? If not, is it worth the effort, especially if you consider the sum of the parts? And if yes, what percentage of Altron's operating income or EBITDA does it currently represent, and what is the target in 2025?
Andrew.
So thanks for that, Nicholas. And if we look at the results prior to the COVID pandemic and the financial slowdown, certainly the rest of Africa was outgrowing the South African economy by a couple of percentage points. But unfortunately, the Africa operations, and particularly Africa as a continent, have been harder hit than the South African economies. And what we see in FY21, included in the numbers, is a loss of around about 13 million rand in the AROA. Our response to the losses and the future outlook is we pulled back on our investment into Africa, so we will be making no capital allocation into Africa from an investment point of view. We will then allow our operations and Mteto focus on let's say not the silos, but the individual operations, and those individual operations will continue to grow relevant revenue in the countries which we are represented. We've got 6 countries at the moment. There's some work to do around Mozambique and some work to do around Mauritius. And once that work's completed, I think it will be returning back to a profitability, and we expect a low growth number. And I think it will not be that material in our 2025 forecast. So I don't think we should sort of count on an exceptional performance out of AROA in the next 3 years.
Thanks, Andrew. The next question touches on Carabina. At the time that Carabina was acquired, Mteto predicted profits of 100 million by FY22. Clearly, this is not going to materialize due to the loss of a material customer. What profits are being targeted for Carabina by 2025?
And yes, when we acquired Carabina, we really had a strong, when we look at ahead, we could see the growth of the Microsoft ecosystem, and we knew that if we could just align with that growth, we would be able to get to some of the goals that we had set for ourselves. It was never to be. In fact, this customer that you are talking about, which was contributing about 30% of the revenue of Carabina, set us back. But it was not just that. Also, operationally, there were a few things that needed to be fixed in Carabina. I think that setback, it set us back 2.5 years. So if we were to look at where we are now, I see it as a starting point really of Carabina, where we're seeing it doing exactly what we have expected. And I would add 2 years, 2.5 years in terms of the plans that we have had. So we see great opportunities for this business going forward with the fixes that we have done, but certainly we have been set back by 2 to 3 years.
Thank you, Mteto. To address the next question in the stream, will proceeds on disposal of identified businesses be returned to shareholders, or will they be used to bolt on acquisitions, locally and internationally? If the latter, have you identified other acquisitions apart from the one recently reported?
Cedric.
I'll take that. Thank you. That's a great question. So Mteto did touch on our capital allocation strategy. I think suffice to say that we're always on the lookout for acquisitions, specifically acquisitions within our growth areas. Besides the Law Trust acquisition that we have announced to the market recently, there's currently no other acquisitions on the cards. But as Mteto have spoken, and Andrew's also touched on, in our Ubusha business, in our security business, the building of an operation in the UK, albeit on a greenfield basis. So in the absence of any additional acquisitions, we will certainly have a look at our debt levels, and should our debt levels be deemed efficient, we will certainly look at either special dividends or share buybacks, depending on valuations at that time. I think what is important to note is that we will not necessarily build a war chest. We would not really tolerate a lazy and efficient balance sheet. But we really want to have predictability around our dividend cover. So our dividend cover will probably only be lowered from the current 2.5 times if the board is comfortable that that ratio can be maintained on a sustainable basis.
Thanks, Cedric. The next question within the chat is, what positives has COVID-19 done for the Altron Group? So many companies report on the negative. which no doubt there have been many, but what tangible positives have there been across the group?
So thanks, Nicholas. And I want to focus on sort of two areas and answer that question, both internally and externally. If you look at internally, the first COVID cases, obviously early March last year, and the first lockdown announced towards the end of March. What we were able to do in a very short period of time is move our workforce remote. And we had 7,500 people moved home, and a large portion of that workforce continued to work remotely. Since then, we've put in a hybrid working model with people working from home and work, and underpinning the sort of the collaboration and the productivity of our workforce. And that's worked for us very well. Then if you look at externally, what's happened is the world's removed geography from a criteria of doing business. So people are now working from home, they're working remotely, they can work from their holiday homes, they can work from overseas. That has given us a lot of opportunity, let's say, to deliver services from here into the rest of the world, and using a relatively weak currency, and that sort of currency arbitrage into offshore would benefit us. And then if you look at our focus segments that were set up 3 years ago, particularly the data environment, the cloud and the security environments, all of those have been accelerated into this COVID period. So if you look at cloud, lots of companies, by removing geography, have to have moved into the cloud. Now, that doesn't impact just Azure or AWS, but it does impact licensing, so the pickup of the LSP within Carabiner and the move from an EA type of environment into a CSP environment has been accelerating, and we'll see the results of that. And you can particularly see the results of that in the UK business that was demerged. And if we emulate that, there's value there. Then as we move ourselves home, what happens is the data is exponential growth on the data, because we are all producing data on a day-to-day basis sitting at home. And that data, the management of the data and how to mine that data, is firmly sitting within our systems integration environment. And then the driver on security, and particularly what we've done with Altron security and what Ubusha brought to the table, identity access management. And then Mteto touched on law trust. And what law trust is, that assurance around the identity of the individual coming in. So the digital identification of the individual. You can imagine how important that becomes, because you can be sitting in your favorite coffee shop delivering services into your organization. So how do you identify, how do you assure that it's the right person, and then how do you give that person the enablement? And all of these have been great accelerators for us within the Altron space. So thanks very much for that question.
Thanks, Andrew. That concludes our Q&A session. I'd like to thank Mteto, Andrew, and Cedric, and most of all, I'd like to thank you for joining us for our results presentation for FY21. Thank you.